If you're serious about investing in real estate, you've come to the right place. It's a tough and yet very rewarding business, but to succeed, you really have to know your stuff. My name is Tom Lundstedt, and I first learned about real estate investing way back when I was a rookie Major League Baseball player. We didn't make the millions of dollars today's players do, not even close. Plus, I wasn't that great of a player, so I spent most of my time sitting in the bullpen where the pitchers and catchers who aren't playing go. And luckily, there was an old pitcher on our team. I think he was about 35, who had done pretty well investing in real estate. While the games were going on, he and I would talk about investing, and that really fired me up. As a matter of fact, it fired me up so much that I've been involved in buying, owning, managing, and speaking about rental property ever since. I've spoken to more than 2,500 real estate audiences from sea to shining sea, and I'm always amazed at how, even though things like interest rates, rents, expenses, and local markets are always changing, the fundamentals of real estate investing remain constant. To help people master these fundamentals, I've developed a series of CDs and study guides. They aren't a bunch of get-rich-quick baloney, they're the real deal. The fundamentals are time-tested and true, and they're a must for anyone who plans to succeed as a real estate investor. At the website, howtoinvestinrealestate.org, you'll see a sample of some of the information found in my CD programs. By using a terrific one-page, easy-to-use investment property worksheet, I'll show you how to analyze a property before you buy to determine if it makes financial sense. Topics such as cash flow, tax shelter, depreciation, cap rates, and return on equity will all be covered. We'll even cover how to use your IRA to buy and sell real estate. I can't believe how few people know they can do that. Now, before we go any further, I've got to put in a disclaimer. We're going to discuss some important tax issues, and I want to make it clear right up front that I'm not engaged in rendering legal, accounting, or other professional services. Everyone's situation is unique. So, before you take any action, please take the ideas you learn here and discuss them with your tax manager to see how they fit your unique situation. I'm saying tax manager on purpose. I'm talking about someone who help you manage your tax situation, not just prepare your tax return. So, let's get going. Whether you're a rookie investor or a seasoned pro, once the dust settles, I hope this website, plus the CDs and study guides, will help turn you into an all-star real estate investor. Okay, let's get started. What you're seeing here is part of a seminar I presented to a group of realtors. We use the investment property worksheet to analyze the 4 financial benefits of owning a rental property. Those 4 benefits are cash flow, principal reduction, income tax savings, and appreciation. This 3rd chapter deals with the topic of income tax savings. We'll be using the same example that we used in each of the other chapters. A woman named Janet who is considering the purchase of a $130,000 small apartment building. The terms require $18,000 cash invested and a loan of $112,000 at an interest rate of 9.5%. The payments are $945 per month. In previous chapters, we've already covered how to figure the cash flow and the principal reduction. In order for this chapter to make the most sense, it would be best for you to listen to those other 2 chapters first. Now, don't get all hung up about all the minute details or whether these numbers would be realistic in your specific area. Just follow along and concentrate on how it all works. Once you know how it works, you can apply these same techniques to any rental property in any market, big or small. Here we go.
3rd benefit. It's 11:30 p.m. on the night of April 15th. And Janet is thinking, I better do my taxes. Well, what's her taxable income on this property? What's her taxable income? How much money does she have in her pocket from this property? $1,425. What's her taxable income? $1,425. Well, now wait a minute. What about this $731, the principal? Is that taxable? Taxable when? When she sells. Now look me right in the eye. Back your mental tape up 11 feet. Stop it and start over, because that's wrong. And you should know that's wrong. When you sell your property, you don't pay tax on your mortgage. You don't pay tax on your equity. You pay tax on your what? Gain. Your gain. Your gain and your equity have nothing to do with each other. Your mortgage has nothing to do with your gain when you sell. This principal reduction is not taxable when you sell. It's taxable every year. Both of these numbers, the cash flow and the principal reduction, are taxable to Janet every year. Does it make sense that the $1,425 cash flow is taxable? Sure, that's logical, because where'd she get that money, the $1,425? It came from her tenant, right? It's the profit from her tenants. The IRS says, Janet, you got $1,425 in profit. That's taxable. Well, that makes sense. We'll take that logic one step further. Where did she get the $731 that she used to pay down her loan? From the tenant. Here's the IRS's rationale. They say this: if the money comes from your customers, it's taxable. And see, both the $1,425 and $731 come from her customers. They are both taxable. What if Janet took $1,000 of her own money out of her own bank account and used that $1,000 to pay extra on the mortgage? Would that principal reduction be taxable? No, because that's her money. Both of these are taxable because they come from the tenants. That's the bad news. But there's always good news. The good news is, yes, they are taxable, but they can both be sheltered by the depreciation. You see, Congress, who writes the rules, wants Janet, or any of us, to buy the property. She's going to provide housing for these wonderful people. She's going to fix up the neighborhood. She's going to invest her money. Whatever's left over, the seller's going to go out and buy stuff. And all those people pay tax on the money. And the seller pays tax, everybody pays tax. And so she creates a lot of tax by buying the property. They want her to buy the property. As incentive for her to buy this property, Congress says, Janet, if you buy this property, we'll let you write it off as if it's going to zero value over time. We recognize it might be going up in value, but we'll let you write it off as if it's going to zero value over time, and that process is called what? Depreciation. Technically, absolute technically today, it's not called depreciation, called what? Two words, I bet you've heard them. What's the technical term for depreciation? Have you heard the term cost recovery? You have, haven't you? Cost recovery, depreciation, same thing. Means the same thing. I'm going to use the word depreciation in here. I'm confident your accountant, your attorney will use the word depreciation. Even the IRS uses the word depreciation on their forms. But if a customer in the marketplace says to you, gee, what would my cost recovery be? You go, man, I don't know. We didn't talk about that. No, cost recovery, depreciation, same thing. Well, look at Roman numeral number 3 on your worksheet now. This is how you figure the taxable income. This little formula right here. And this is how you'd figure the taxable income on any business in America. It's nothing more than the net operating income minus the interest minus the depreciation to which you're entitled. Well, that doesn't look so bad. Let's help her out. Here's our friend Janet. What's her net operating income on this property? Net operating income. $12,765, right? It's the one with the star by it there in Roman numeral 1. $12,765. Well, then, so she starts with that. Then the next thing she had to pay out of that net operating income was her debt service. But is her entire debt service deductible for tax purposes? No, only the interest. How much interest did she pay? $10,609, right? Notice you can only deduct the interest. You cannot deduct the principal. You have to leave the principal in there. And that has the effect of making it taxable. Net operating income minus the interest minus the depreciation. And this depreciation is what we need to talk about just a little bit in further detail. When you buy a property for $130,000, what you've got to do is divide that cost into its parts. What tangible physical assets would Janet be buying if she bought that property for $130,000? What's she actually buying? Land. What else? Building. Keep going. Personal property. And then land improvements. See these 4 things I've got? Land, personal property, building, and land improvements up there by the top of your worksheet. Those are the depreciable assets, or those are the things when you buy a property, a rental property, you need to divide your cost into those things. Each of those categories is depreciated differently. And so you want to divide it into those categories. Now, the reason you do it is each of these categories is depreciated over a different number of years. So what I'd like you to do, let's write the number of years next to each of these.